Thank you, Alicia.
Thanks, Kate. Kind of make me sound really professional.
You appreciate that.
All right, good morning, everyone. Thank you for being here. I know not everybody gets as excited about taxes as I do, but I love taxes. I understand if you guys don't, but I do love them. As I'm hoping every one of you know, we had some major tax reform this year. The idea was to simplify our tax code and make it easier so that individuals could file on their own. I'm sure many of you heard the rumor that we may have a postcard tax return. I don't think there's any way that could ever happen. That was somebody's pipe dream. But instead of making things easier, it is my professional opinion that they actually made it even more difficult. So for individuals who have small businesses who used to use services online like TurboTax or Tax Act, it will be even more complicated for you to do your taxes. And this is the year, if there is any year, for you to seek these services of a professional. Just make sure that you're doing it right. And so in front of you is a handout. I'm not going to read directly off of it. This is supposed to be a tool for each of you to take home and refer back to. There's some good facts in here. Anybody else not get one? So there's some good facts in here that compare the prior tax legislation to our new tax code. And the things that are going to apply to most of the people in this room have to do with the changes to our itemized deductions. So I'm sure most of you heard that there's now a $10,000 limitation on SALT, which is state and local taxes. So that is a combination of your state taxes that you pay either through withholding, through estimated payments, or pay at the end of the year when you file your return. So that's the S. Your local taxes would be your personal property taxes on your vehicles, boats, RVs, etc., and real estate taxes. So those three together, so real estate taxes on your primary residence or secondary home. Rental properties are not included in the state and local tax limitation. I get asked that at least once a week. So if you have a rental property, you did not have to run to the court or run to the clerk in the recorder's office and try to prepay your tax bill. That is completely exempt from the new legislation. So the other changes on your itemized deductions that will affect many of you will also be the limitation, the elimination of any unreimbursed employee expenses. So if you are an employee of either somebody else's business or an employee of your own businesses, the Form 2106, which accounts for your own out-of-pocket expenses as part of your employment, is no longer applicable. So as of last week, I heard there's a rumor that they're trying to take a step back on that one and possibly bring it back in. But I would say at least a third of my clients have that deduction. So that is a big deal for many of the people that I work with. The other major change is that they doubled the standard deduction. Those statistics are in here, I believe, on one of these slides. They are very hard to read on some of these. I believe it's on page 2, slide 8. So they doubled the standard deduction and they eliminated personal exemptions. So an exemption is one exemption for each person on your return. So if you are a family of 4, you have 4 exemptions. Those are all gone. Instead, they wrapped it into the standard deduction, and then they also doubled the child tax credit. So previously, you would receive $1,000 for any child ages 16 and under. It is now $2,000 per child. So for many families who have children under the age of 16, even though we've removed the exemption, they're still in a better state. So I would say the vast majority of my clients will have a benefit under tax reform. There is a certain bubble of people either at the very high tax brackets or in the 200 to 400 range, there's a small group of people who also will have an increase in taxes as a result of tax reform instead of a tax benefit. So many of the people in this room, you will see a benefit. Some things that I want to highlight. Go to a different sheet. So maybe that one things to highlight. There were some rumors that they were going to get rid of the student loan interest deduction. That is gone. That's a rumor. It did not happen. They talked about getting rid of the deduction for teachers as an above-the-line deduction. That did not happen. They talked about changing the rules on alimony. That was a big deal and does affect many of my clients. That did go through, but there's a delayed effective date. So if you are to get divorced in tax year 2018, and there is a maintenance component, and if your divorce is final before the end of the year, then that maintenance, per your agreement or per your final decree, can be tax deductible to the payer and is income to the recipient. You can waive out of that though. But anybody that had filed prior to that or who is currently paying or receive alimony is grandfathered in and still under the old rules. Other things, mortgage interest, that was not eliminated. One thing that was changed though was the threshold. So if you, let's see, find on slide number 9 on page 2, there are limitations in place. So if your mortgage is over $750,000, again, this is on a primary residence, not a rental property or other investment property. But if your mortgage itself is over $750,000, you are limited on the interest that you can claim as a deduction. I don't know how many people in this room that affects, but maybe some of your clients are affected by this change. Medical expenses. This was the big one, and it was one of the few rules that was made retroactive back to 2017. There used to be a 10% limitation on what you could claim for medical expenses. So 10% of your combined household income. So family of 2, $100,000 a year of income. The first $10,000 of your income that is the ceiling. So you have to have $10,000 of medical and above in order to receive any benefit for medical expenses. The change that they made, again retroactive back to 17, is that threshold went from 10% down to 7.5%. So this makes it easier for families to write off medical expenses. The reason they did this was because the out-of-pocket expenses for healthcare have gone through the roof as a result of Obamacare. So this is their way of trying to give you one up. Let's see, other items of note. The capital gain exemption on the sale of a primary residence. So the current rule, and this did stay in play. They were talking about changing it, but thankfully they did not. If you own your primary residence for 2 of the last 5 years, you can exclude $250,000 of that gain. Or if you're married, you can exclude up to $500,000 of that gain. That's a big deal in here in Boulder when prices are just skyrocketing. So it is actually fairly easy for us to come up with a mechanism for you to take the full exclusion even if you're under the 2-year threshold. So that's something you need to plan ahead for. So if you do have a property that has more than the exemption amount, either $250,000 or $500,000, has grown more than $250,000 or $500,000, and you're looking at selling that property prior to the 2-year threshold, talk to me first, because there are some things that we can do to plan ahead and make sure that you get that full exemption. Carrying forward, I want to skip ahead to slide number 13 on page 3. This is a new one that I really love. The 529 accounts that many of you have either for your children or grandchildren or nieces and nephews used to only be eligible for use with higher education expenses. So college, grad school, med school, etc. Under the new law, we can now use this for any education, starting in kindergarten. So if you have children that are in private school, you have children that are in any sort of school where you have to pay for them to attend, you can now use these 529 accounts. And what you do, you transfer the money in, and then you pay that tuition directly out of that account, or you reimburse yourself or the child, if they're a child in college and they paid for it, you can reimburse them through that 529 account. The other thing is that you can also use 529 accounts for room and board for college kids. So if your kid is on a full scholarship or they've got student loans and you're still giving them money for room and board, you can funnel it through that 529 account and get a state tax deduction for it. It doesn't help with your federal, but it does help with the state. So you'll get a 4.63% savings on every dollar that goes through that account. The biggest change, again, is that you can now use this for any education, not just higher education. Other things, I want to move away from the individual changes and skip forward to the part that I'm most excited about, which is the deduction for pass-through income. So how many of you in this room are self-employed? Almost all of you. So this affects every person in this room who is self-employed. It affects people in this room who have rental properties or any sort of pass-through income, whether it's Schedule E, Schedule C, which is a sole proprietor, single member LLC, a partnership or S corporation. Rental properties can also be subject to this new change. LLPs, any sort of pass-through, some trusts and some estates as well. So what happens is we talked about S corps. I've had presentations in here before where you're bifurcating your income into two different buckets. You've got your active income and your passive income. Your passive income is now subject to a 20% deduction. So they're adding a new form to your tax return. They haven't told us what form it will be, but it's going to look similar to a Schedule SE. And so they will take the passive part of your income, if you're an S corp, a rental property, an LLC, an LLP, etc., and take a 20% deduction right off the top of that. So a scenario would be you have an S corporation that has $200,000 of profit, half of which came through salary, half of which came through as a profit on your K-1. The K-1 portion will now be subject to this 20% deduction. This is huge. And your Schedule C will also get a separate 20% deduction. It will not affect the self-employment tax, but it will affect your ordinary income tax as a result. So on slides starting 16 and basically through the end of this sheet, it goes through the mechanism by which they plan on facilitating this. We've not seen the forms. I'm not sure yet exactly mechanically how they're going to do it, but in theory, it is outlined in here. And so what we want to do with many of our clients is make sure that we can keep them under the threshold, because there are income limitations on this. If you make over a certain amount and you're in a certain field, such as an accountant or an attorney or any other professional services, if your income is over a certain level, you don't get this deduction.
What is that level?
It is, I think it's $415 if you're married filing jointly, or $2,075 if you're single.
Gross,
and that's
the
top part.
Gross,
that is the net income from your business. Excuse me, that is the taxable income. That is not net income from your business. So they look at your spouse's income, they look at investment income, all of that together is what creates that threshold. So with people who are approaching that limit, we want to do as much planning as possible. One of the new tools that they have given us this year, and it's the other item that I will mention, is retroactive back to 17. is that they instated a 100% bonus depreciation deduction for many expenses. Ones that are notable, and I see a lot, and this, again, effective back to 17, was that leasehold improvements can now be 100% deductible in the first year under bonus depreciation. That is a big deal if you're opening up a new office. A lot of equipment, certain vehicles, also we can take 100% in the first year. This is, as I said, a really big deal and a tool that we will use to keep our clients below this threshold. Let's see, other things of note. They've changed some of the net operating loss rules. You can no longer carry it back. So if you have a business, first year out of the gate, you have a big loss, you just left your corporate executive job making $500,000 a year, it used to be that we could take that loss, carry it back 2 years, and go reclaim some of your taxes that you paid 2 years ago. You can no longer do that, which is unfortunate, but it does make my life a little easier because it's not easy to do.
You can carry it forward, though.
Now you carry it forward, correct. There are some other limitations that are in here. I will skip over those. Fringe benefits. How many of you have employees that you often take out to lunch or take out to lunch, go do parties, go to boondocks and go race cars, go golfing, skiing, etc.? Anybody? Yeah. You no longer get a 100% deduction for some of those items. They're now limited to 50%. So in certain instances, you were able to do 100%. Now, not at all. Other things. There's some limits on the interest expense for businesses. I don't know if anybody here is going to hit the threshold on that. I want to go back to the 20% business income deduction that has been applied. If you look on, slide 19 on page 5, those are those income limitations. And that also outlines the fields that the IRS has identified as professional services that make you subject to these limitations. So one of the ones that we watch out for are people in the field of consultants, because the IRS has determined that a consultant is professional services. We get a lot of people that come in and say, I'm a consultant. Well, what do you actually do? So we try to move them out of that field and into finding something else. So if you are a business management consultant, maybe we move you into a field of mergers and acquisitions or something outside of that terminology, because they're making consultants subject to these limitations. And it is my strong feeling that consultants will be the next group of people who are going to be flagged and audited. So do not use that word. It's a dirty little word right now. So sorry to skip through those very quickly, but I wanted to give people time to ask questions and see if I can provide clarification. So, anybody have a question? Rob.
So my wife does something similar, but she works more in the executive field with larger companies and bringing programs to them, and it's an executive leadership company.
So leadership.
So leadership is a.
If we can get her away from consulting and get her away from the handful of fields that are identified in there as professional services, we can probably get away with it.
And that's viewed differently, the word leadership versus consultant.
Mm-hmm. Do not use the word consultant. Mm-hmm. Anybody else?
Thank you.
Jim.
Unfortunately, oftentimes it's the case for my clients that they are relying on alimony or child support or separate maintenance or something like that to qualify for a loan.
No.
And so, is that gonna now be, what is the change there? You said there was gonna be a change, but
The
not aware of
change
it.
is, starting with 2018 tax returns, which are filed in 2019, maintenance and alimony for people who are newly divorced will no longer be included on their tax return. So you will need to rely upon their final decree, which you have to do for child support anyway. So
Right.
you'll be able to still work that in.
So is it no longer deductible then?
It's
if
no longer
alimony?
deductible to the payer and no longer income to the recipient. And I've seen a lot of attorneys here in Boulder who practice family law who have already been writing it into their agreements and decrees that there is no tax implication for spousal support. So
Wow.
you will just need to almost always ask for their decree just to support the income.
Yeah, which by the way, we can't do.
Really?
Yeah.
You asked for mine.
Well, that's because you told me that you had this, you see. If you don't reveal that, I can't discover the source of your income.
Right. So I think that for your clients who have it as income, they're going to be forthcoming with you on that. For your clients who are paying maintenance, they probably will not tell you unless you find it on your own.
Yeah, which is unfortunately easy to do.
I know.
That's
All right.
interesting.
Anything else? Keith?
Travel and entertainment expenses, can we still write off client, entertaining clients? for-
Yes, it's the fringe benefit portion that is gone. So that's what you're paying for your staff, your employees. Brent?
And HELOCs, tax deductibility.
They're still deductible,
Okay.
as long as it's on their primary residence, actually secondary residence as well. But there has to be a connection between the house and the mortgage. So they can't take a $20,000 loan to send their kid to college and count that as mortgage interest. The money has to go back into the house. Again, there's no way for us to track that, and if the client says, yeah, it's a HELOC, we did home improvements. There's nothing for me to do to
And that's up to the 750
further.
max?
I'm sorry,
And that's up to the 750 max total?
Yes.
Yeah.
Okay.
yeah.
Okay.
And honestly, the IRS probably would not know either. I mean, if they saw 20,000 going into your bank account, you took did a cash out HELOC, wrote yourself a $20,000 check, it's going to be hard for them to say, oh, where did that money go? If you took 100,000 and you could see, I bought a boat with it, it's pretty obvious that that did not go into your house. Yes.
On the state and local taxes,
Yes,
the 10,000, is it double for a married couple?
it is not. Yeah. So a lot of our clients here in Boulder are approaching that threshold because property taxes here are a lot higher. But then again, with the property taxes being a lot higher, a lot of our income, or a lot of our clients who have those homes aren't really working anymore. So they're not paying any income taxes. So we only have a few really that are significantly impacted by the SALT limitation. And we did have a lot of people that prepaid at the end of the year, and there's going to be some issue with that, I think, coming up. So, you had a question?
Yeah, with all of the self-employment deductions that they're changing, is that going to drastically affect their personal AGI?
So,
Kind of similar to what Jim's talking about qualifying for loan pieces.
right, so it may or may not affect the AGI. I'm not, because they've not shown us mechanically how it's going to come together yet. I don't know yet whether that 20% deduction is going to come on the first page, which is below, or which is before your AGI, or if it's going to come on the second page, which is after. We don't know yet, but I'm sure in the lending world, they will make accommodations for this, and that 20% should not have any impact on your lendability.
If anything, it'll help qualify because you're paying taxes on 20%, less on only 80% of your self-employment income.
Yeah, or all pass-through income.
Yeah. Well, you get a exemption, if you will, for the first 20%, so you're only paying taxes on 80%
Right.
of your pass-through.
I'm just eliminating the self-employment term that you threw in there.
Oh, okay, got it, yeah. So,
The child tax credit, it's for children 16 and younger, right?
Correct,
Not younger.
yes. So if you have 17-year-olds, you're in this little abyss of your tax goes up for a year, and then hopefully the next year they go out to college and you start to get the college education credits. So for 1 year, things get a little painful. Jim, do you have more questions?
well, I'm saddened to learn that, that I can't take my employees skiing and write it off anymore. And I think that sucks.
It does.
Yeah.
It does. And there's going to be some further discussion on that because it affects so many people and there's just a huge backlash on it. So there are some bills that have been introduced last week that would potentially bring that deduction back into play. The other component is they're going to do some additional language on the nominal turkey. So if you give your employee a gift, it cannot be any more than a nominal turkey gift. And this is an actual thing. And so they've limited it to around $25. You're allowed to give your employee a small gift, but anything above that amount is considered income to them and must be reported on their W-2.
How many small gifts can you give?
That's a good question. You couldn't give them a gift every day, but let's say you give them a $25 gift once a month. I don't see a problem with that. But you cannot give them $500 and it not be income to them.
Is that just cash? Sorry.
No, it's not just cash. So
So
it's,
you give them a fleece with the company logo.
Yeah, but that's
you can
that's due to
either,
like what happens out in
That's
Hollywood and stuff like that, where they actually
That's a
give out
uniform.
gift bags, and those are being highly watched by the IRS basically at this point.
they are. But if you gave somebody a fleece that had your logo on it, that would be okay. That would be considered part of their uniform. The purses that I buy my staff members, I do not get to deduct because I bought everybody in my office a Coach bag for getting through tax season. I don't get to deduct that because that is above the threshold and I would have to report the value of their purse on their W-2, which I'm not going to do. I know.
All right,
Here's a
well, thank
gift,
you.
now you're going to pay taxes on it.
Thanks, Alicia, that's awesome.